Thomas, we are back, my friend.
We are. Dan Sheridan in the house. How are you?
Good morning, Tom. Morning, Tony.
Good morning, kind sir.
Good morning. See you guys.
We got so much stuff going on this morning, Dan. I'm sorry. I was just trying to catch up during during the last break. Vanetta always sends me going like 17 different directions.
That's okay.
I always say we have to film the breaks. That one, you would have just heard silence. Dan walked in. I said hello to Dan.
These guys are
Dan
working.
sat down. Tom's typing away.
Busy morning.
Somebody just emailed me. This is a true story. Somebody emailed me about maybe 15, 20 minutes ago, and they go, I just saw you on the show. Who's writing your emails?
Well, somebody said, I just saw you on the show, and you must have answered an email to them. And they said, who's writing your email?
Yeah.
Like you have like a...
Yeah, an email person.
An email person.
An email person. Like
I mean, when I've known you for a long time and sent emails, I thought that at first, because I said, no, I've never seen anybody that good on emails. And the problem is you make it tough on the rest of us because Tom is
best
right.
of us for the rest of us.
Yeah. So, yeah, you're the best at getting back.
When we,
Can you
years
tell me
ago,
how? Can you tell me how?
years ago, for the first couple of years of Thinkorswim, Scott and I answered all our own, every single email, and we're like, okay, we can't keep doing this.
That's your first marriage, first work marriage.
That's
yes,
right.
I understand.
So
we don't like to talk about the first work. I mean, like
there's
it's
a little
just,
jealousy here. I like that.
It's just kind of off limits.
Yeah.
You know
That's
what
right.
I mean? I mean, like, why talk about your other work marriage when you're
Here I go being
when your
Dr. Phil
significant
again. Here we
other
go.
work marriage is still in the room with you?
Look how sensitive he is.
Okay.
I know.
Okay. Because and then he starts tearing up. It gets ugly.
Bringing up the X.
There will be no ice for you tomorrow morning in your cup, just so you know.
There'll be no ice in
But then, so one day I can't take it anymore. So I hired this kid. And I'm like, listen, we're gonna work together. I'm gonna teach you all all this email stuff.
Yeah.
I hired a couple of kids, and we're gonna get all this email stuff, and you're gonna be able to help me with my emails because I'm overwhelmed.
Sure.
I can't run the company and answer my emails and stuff.
Yeah.
So, and he's like, this is awesome because I can learn how to trade. I can do all this kind of stuff, because I had a big desk, and I go like you're sitting right here.
Yeah.
Like you're 6 inches away from me.
Yeah.
Like everybody used to say, what's that kid doing sitting next to you? I'm like, because I kept him there for like a year. I'm like, and he was the nicest guy. I mean, he was great, smart, figured it all out, kind of whatever. But then I realized, you know what? It doesn't matter. You can't, there's no formula that works to have somebody answer emails. It just can't do it.
Right.
There's nothing you can do. Like you have to just do your own emails.
So now you do completely yourself?
I've always done completely myself. I never gave it off. I had him answer the company and things like that. And over time, it turned out to be a 20-person email team, over time, just answering, responding to customers. 20 people.
Support emails, not
support emails. My own emails, I've answered every one. I think I've done a couple of million emails over the last 10 or 12 years.
Easy.
Yeah, easy. But it's healthy. It builds.
Got a little callus on your finger, yeah, right?
Do you know what? I'm fine, actually, surprisingly. And consider I never
held up well.
Consider I'm never.
This is holding up well.
But you don't answer any on the.
Well, hold on. Dan, for a minute.
Sorry.
That's fine.
Well, I don't have
held
carpal.
Up well.
I don't have. I have no my hands still
work.
work.
You can watch this in HD now. That's fine. You gotta be kidding me.
He says, "Hold up, Dan. Wait a second.
I haven't broke down. No carpal tunnel syndrome. Yeah. No. I'm not even I never learned how to type, so I'm a hunt and pecker.
Oh, I am.
I'm a pecker too, Tom.
But let me just to put a little reality here. You don't answer emails on the. I mean, I look at that iPhone. I'm like, give me a break. I mean, you don't.
iPad.
Okay, so that's a little okay.
iPad, I do. Tony answers on iPad.
Yeah,
iPad.
I mean, I can answer emails on an iPhone, an iPad, or my laptop. Obviously, my laptop is.
So can 50 other million Americans.
I understand.
I mean,
I don't answer customer emails on my iPhone. I think it's just too slow. But I do on my iPad for sure.
Okay.
I'm pretty. iPads are about one. What do you think? They're about 1/3. You could do about 1/3.
Yeah. Okay. No, I think it's amazing what you do with email. Honestly,
email, but it's an addiction.
I'm bad.
It's an addiction.
It is an
understand.
addiction.
It's an addiction. It's actually the way. I mean, some people would. I guess it would be if it was. It could be a medical disease. I think it's an addiction.
Have you ever stepped away?
Never.
Like for a day? Like did you ever go just get off the grid for a day? I'm being serious.
Never really.
Because
I tried
having
like
that,
but isn't one of the problem
discussion with me at night?
Oh, you're going off. You're going off for the grid.
No, but she's asking me can you just not Saturday? Let's just.
All right, but if you went away, here's the problem. If you went away for 2 days,
you can't catch
you'd
up.
have 12,000 when you
just
come
can't
back.
catch up.
Yeah.
I know. Weekends, people have been they're less, so it's more
A little
manageable.
sanity.
But during the week, I couldn't take a
Anyway,
day off a week.
you guys
Yeah.
are the
Wait till you
best.
see one of the. Wait till you see one of the. I have a cherry bomb coming up, which I haven't. Which I have a cherry bomb coming up because I usually do them to. You don't know what cherry bombs are, but they're a little thing we go out at night and I have it to different songs. Well,
I
have a
see them in the morning. I do.
Okay, so I have a cherry bomb coming up that you'll have to know a specific song, but it's gonna be very funny because it's all tied to email. Whatever. I don't want to spoil the email surprise here. So Dan, we had yesterday what I consider to be strange market action in the sense that the market has a tendency after a down expiration Friday, which we saw the down move on Friday, has a tendency to get a little bit nasty at some point the following day.
Right.
There was almost no downside action, and Apple kind of put the market on its back, carried it up yesterday. Stock was up $25. It's actually down about $4 or $5 this morning, but stock was up $25 yesterday. The Nasdaq exploded. The S&Ps ended the day up about $5 or $6, but they just nothing ever looked ugly yesterday, and it was a classic. It was a classic trap. So today's the down move.
Today's right.
Yeah,
Today.
today's the down move. S&P's down 17. Nasdaq's down almost 30 points. It's trading below yesterday's lows. Today's the hard day for me because yesterday was the easy day. Today's the hard day because you're opening down 1%.
To figure out what the market's going to do, you're saying.
It's not, you never try to figure out what the market's doing. You try to figure out what you're going to do. There's this popular misconception that individual investors should be trying to figure out what the market's going to do.
Good luck.
If you want to take one thing out of today's show,
but Vol's going to expand.
It's going to expand by Vol's going to be up by 5, maybe even 8 or 9% today. So, but everybody tries to think what the market's going to do. Okay. And the really successful investors and really successful traders need to think about what you're going to do. Okay.
Either with your position or with positions that you want to put on.
I'm trying to get I'm trying to distinguish what successful traders used to do. You would go to the floor of the exchange, or you would go in front of your screen, Dan, every day, and you'd say, what am I going to do today? You don't ever care what the market's going to do.
That's true.
All you care is that there's business.
That's all you can control. You can't control what, I mean, that's the whole thing. I can't control what I mean, I can look at technicals all morning long, and what is it? I mean.
Dan, exactly. But individual investors, by definition, try to think what the market's going to do. And there's some idea that if you can outthink the market, or if you play some kind of focus, you can actually, that's how you make money. But that's not how you make money. How you make money is, it's what are you going to do?
That's all that matters. Right. You look at your positions, or like on a day like today, okay, like as Tony said, the vol will be up. Maybe VIX will hit 19 or 18. I don't know if it'll hit that high. That sounds high, but maybe 18. Maybe it'll hit 18. So, again, in the program.
Do you take off positions here that were vol sensitive and you have a profit in them, or do you let it ride?
Well,
it just depends what your risk reward is. If you have a spread, let me ask you a question. I'll put it real simple. It doesn't have to matter what the VIX does. We have a VIX spread on. This morning, we spent, let's say, $1 on the spread. It's a $2 wide spread. If the spread trades at $1.50 this morning with 25 days left to go to expiration, do you take it off? With 28 days to go, you got 4 weeks left to go.
Well, I mean, just without knowing all the details.
There's no details to know.
All right, let's say
you
I
buy
had 10
something
of
for
them.
$1. It's trading $1.50.
Yeah.
You have 28 days to go.
I'd absolutely take off half.
Okay, so minimum take off half.
For a 50% profit in how many days?
5.
5 days. I don't know. For me,
I agree with you.
Period.
At least half,
Whatever
if
the
not
plan.
all.
Now, even if my plan, it depends on the plan.
What's the point of holding any of it? You have 28 days left to go. You don't think you can reload?
I agree, but if not,
minimum.
you do something.
Yeah, you got to do nothing.
You don't sit with your hands in your
Listen,
pocket.
but that's my whole point. It doesn't matter what the market's going to do. That's my point. You don't care why the market's down or what the market's going to do. All you care about is, hey, I bought something for $1. It's trading for. I bought something for 105. It's trading for 155. Okay, I just want out.
Right.
Okay. There's no decision of like, oh, well, what if the market crashed today? So big deal. You would have made another 45 cents. What if the market? There's $1.50 you can lose, and there's 50 cents you can win. Right. And at some point, you just have to start managing winners. And you know what? It's just a function of being cyclical and reloading. You got 28 days left.
Yeah, and it wasn't it. I think of. You didn't take like when I took the train in when I was going to the SIBO in the morning. I remember I'd be on the train. And based on one phone call, you can, you'd call into the market, okay, and the guy who'd be in the office who had to come in early, maybe the younger guy, okay, what's going on overseas? Okay, let's say we traded IBM. IBM's going to open up down $2 or $3. And then all I'd say is, okay, what are the Greeks? Okay, your delta's here, your gamma's that. Based on that 2-second conversation, I knew basically at the opening, A, was it going to be pleasant or not pleasant, and B, what was I going to do? I mean, you had an idea based on where the spoos were going to open, didn't you?
I'll give you a better definition of that. When we were growing up as traders for a long time, the question would always come out of our mouths, not what's the market doing, but is it busy?
Yeah, of course.
Okay.
Oh,
Is it busy? Like,
well, in the
for
pit,
trades, you wouldn't say what's the market doing, because you got a quote. You get a quote anywhere.
Right.
You say, is it busy?
Right.
Okay.
You need a paper. Right.
Spoos are down 15, but there's nothing going on. All right, fine. I'll stay where I am. But spoos are down 2, but man, I'm telling you, they got orders everywhere. You would see them fly down the stairs. You'd watch them one after the other. Now Scott always got there first because he's, holding up a little bit better than Tom, as we would say. And then you see Tom come, followed by Jules, and with a stumble or two down the escalator.
The funniest thing is when people call out and go, "Is it busy?" Tell them it's dead.
Okay. Right. But you'd hear the noise in the background.
But then if you're away somewhere, like if you're playing golf or on vacation or something, you call up, they go, it'd be totally dead. They go, is it busy? And you go, it's so busy.
Yeah.
That's true. Yeah.
It is crazy down here right now. I can't even talk to you. I'm way too busy. Right. And you'd be like, go back to sleep.
Yeah.
So, but see, that's the hard part that most people don't really understand about trading. It was never a question of what's the market doing? It was always, is it busy? As individual investors, we all think that the method to success is being able to have some form of predictive analysis or some form of predictive ideas, and then some relative to performance to those predictive ideas, when that's not it at all. What it is creating it's being able to put predictive strategies into place and then waiting till those work for you based on whatever, I mean, you do it every single day. You mentor people so that you give them the best chance at some point during the life of the trade of being successful. I've never heard Dan Sheridan once say, I hate the market here.
No, I don't. Yeah. Never. I mean, maybe to myself. Have
you ever said, I hate myself here?
All the time.
All the time.
Yeah. But I do say I hate the market for one thing. I think there's a natural bit, because I look at these strategies and I most fear as a trader the downside and the craziness on the downside. The upside is just like playing Pac-Man at level 1. Not that you can't lose money, but I think that's we can handle it. But the downside, there's a fear. So I think there's a little bearish skepticism, but it has nothing to do with my opinion on the market. But let me ask you, why do you think, now the retail people, there's an attraction to what's busy, where's the volume, where's the, like they're going to jump in if Google's crazy today. They're going to jump right in. I mean, I see that with my guy, what's busy today? Where's the volume? There's a fascination with where's the most liquid options today. Like they're going to jump.
That's okay, though.
But it's always the usual suspects.
Yeah, I think it's okay.
Yeah, it's the usual suspect.
Yeah, but I think it's okay. I'm
Which
guilty.
is a great movie, by the way.
Yeah, I'm guilty of that. And I'll tell you why. I was never guilty of that as a professional trader, as an exchange member, because it was too difficult. We didn't have electronic access. We just did not have electronic access
to different exchanges,
to anywhere,
even across the room.
Floor.
To the next
I did
pit.
not have with electronic access. The game changes, and if you're not seeking liquidity, you're trying to there's a reason you seek liquidity. It's very simple. Your statistical chance of success goes up dramatically with greater liquidity and greater efficiency. It's not like, is this it's not a question mark. It's not like, will I do better if I trade more liquid if I trade more liquid products? And the answer is 100% yes. There's no mathematical or logical equation that works for being less successful trading more illiquid products. In the game, as a retail investor, you have to seek liquidity.
Right, but as Tony said, a lot of it's the same cast of characters.
Of course,
I'm talking when they come up with the volume, XYZ Jack's thing has got big volume. Right, Apple, you want something massive liquidity that you can get in and out. That's what I meant.
100%. We don't. We're all on the same page with respect to that, Dan. It's not. It's. But again, I don't blame an individual investor if they said like for example, Facebook earnings this afternoon. Like if you wanted to trade Facebook today, there's no better day with less, and again, Facebook's earnings coming out after the close. Nobody has any edge today. Like you could think,
That's right.
you could think for 1 second, every market's going to be a penny wide.
Yeah.
Nobody has any edge whatsoever. And if you want to get something done, there'll be tons of liquidity on both sides of the market. I don't see any reason why, why you wouldn't trade that product if there's something you want, if there's a volatility differential or a strategy that you like in there. Today's the best day to trade it.
Absolutely. Let me ask you a question. I was thinking about this on the train home from Tasty Trade last time, as we were talking about earnings and probabilities. And as I look at, when I look at typical trades all day long, I'm thinking probabilities. But when you look at probabilities for earnings, in a way you could almost throw it out the window, because I don't feel as comfortable talking about probability. Okay, you look at Facebook today, and you say, okay, the delta is 10 or whatever, and you say there's a 90% probability if I sell this, blah, blah, blah. But when you're coming into earnings, when you have this event, it's not the same to me as probabilities when there's not this event, because there's a lot of irrationality. Wouldn't you say? I mean, it doesn't
I have to
seem
disagree.
Really? I'm not saying it. It doesn't seem the exact.
I understand where you're coming from, but as we've shown here many times, and we've done a lot of studies on this, the buildup, meaning the expectations based on a binary event, the additional premium that's pumped in, it actually is the exact opposite. So, in other words, what you just said, which is very common, what we found out factually is that the premium that's built in is actually greater than it should be. So there's an excess of premium built in.
In a lot of cases, I think it depends on the vehicle. Sometimes because I mean, it's almost like a crowd mentality where, let's take Google.
Yeah.
Okay, so the last 2 earnings were real slow.
Yeah.
So in other words, if you look at the last 6 earnings in Google or something,
I don't disagree
the last 2 earnings are nothing. I'm not counting this one. The last 2 earnings are nothing, and then you had some 6 and 7s. So it's kind of fickle how the market makers straddle. That's what I'm saying. So I'm saying it's just a little, to me, more fickle than when there's no event. The probabilities make a little more sense. But sometimes, I know what you're saying. Most of the time they do build it in, but a lot of times if the last 2 earnings are quiet and then the third one before moved 10%, they might underestimate the move. I'm just saying it's you have to do a little more homework when you're looking at probabilities. That's why I think people should look at the last 4 to 5 to 6 earnings when they're looking at something to get a perspective. Because if the last earnings were quiet, you can have a 9%. That's what I'm saying. We actually do mention that in a show, and we will look at past earnings just to get an idea of what kind of ranges we've seen. However, what we've shown on here, which is fascinating, and everybody can go back to our market measure segment and look at this. It's in the archives. What we've shown is when you look at I'll use a strangle, for example, and you look at a 1 standard deviation strangle going into a binary event, which is like an earnings play, okay? There's a tendency for the premium levels to be overstated by as much as 15 to 20%. Absolutely.
So which means that if you're looking at that 68% chance of success, the actual chance of success is closer to between 78 and 82.
Right.
So what ends up happening is there is this intrinsic edge, and if you play there's this extrinsic edge, and if you play the other side to that, you're actually being disadvantaged by as much as 15 or 20% over normal non-binary event times. So Dan, the crazy thing about this, and what most people don't realize, is what they think is actually the riskier trade is the safer trade.
What is? But the only thing, and I agree with you in most cases. I do think people should look at the past thing. But here's the thing I like: if I'm trading in, let's say, a strangle, and I'm in,
doesn't matter, XYZ.
XYZ. Well, if there's not earnings coming, at least I have the comfort at times knowing, sure, we can have a gap or whatever. But in most cases, if it's going to move, I may have a chance to get off the train or do something or get out if I want.
Hopefully you get off that train, Dan, because if you don't get off that train,
I know Dan,
you're in like St. Louis.
Dan, I know what you're saying.
Yeah.
But what I'm saying is statistically, it's the other way around. Statistically, there's greater edge built into that binary event, because as you get that implied volatility pop, there's greater edge in that binary trade than there is in the normal trade.
And there should be. There should be, because you've got this event. There's no jumping off the train. Once you commit to a short strangle, you're locked and loaded. The train is closed. You ain't getting out until the train stops, and you don't know where the train's going to stop. It's like getting a hotel on Priceline. You press that button, right? And it says, you're in.
I hear you.
That's all I'm saying. I mean, but I'm with you.
The known binary event is much more efficient, is much more loosely priced than the unknown. Okay. So what ends up happening is you're better off playing an event that you don't actually know what the outcome's going to be, but you know there's going to be an event, than playing, the worst time to play is when implied volatility is too cheap. And so any reversion to the mean hurts you. The best time to play is when there's a known event. This is the fascinating part about everything we do here.
Yeah.
But the known event is actually the best time to play because there's an extrinsic edge built in of almost 15 to 20% over and above the pricing. So the takeaway from this, and this, again, this is the coolest part about what we do. The takeaway is that when volatility is cheap and everything is known, that's the most dangerous time. And when when there's an expected event, okay, and volatility is pumped up.
The volatility is overstated.
It's overstated. Dan, he's Dan Sheridan Mentoring, and good stuff today.
Thank you, Tom.
Thanks. We'll be back in 60 seconds. Listen to Get Tasted on the Tasty Trade Network. Opening bell.
Yeah.